Hi, Michael Yardney here. We're having another Ask the Expert session with Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Thank you, Michael.
Now, Ken, Hamish Blair left a question on our website, and his question revolves around the principal place of residence capital gains tax exemptions. And a lot of people seem to want to know this because they often move into a house and then move out for a period of time, for a longer period of time, maybe change it to a investment property, and they're wondering what happens when they eventually sell it with regard to capital gains tax. So Hamish's exact question is, if you move out for more than 6 years and then move back again, how's capital gains tax calculated on the eventual sale? And does it have anything to do with whether you actually leave it vacant or you go overseas? How does this change things, Ken?
No, great question, Hamish. Thank you for sending that in. Maybe to start with, I'll just quickly go over what in fact capital gains tax is, because a lot of people get confused. So you pay tax on the increased value of, in this case, a property. So the difference in value between your purchase cost and your selling cost is a capital gain, and then you pay tax on that. So the home, though, has a particular and specific exemption. So the home is free of capital gains tax. They call it the main residence exemption. So to calculate the potential tax on a home, we'll take into account a number of things to see if you are exempt. The first one is, when did you start using it as your home? So if you had a tenant in to start off with, then you moved in, they will say they will spread the capital gain over the time you held it, and the time in days that you put a tenant in, that will be taxable. And the time you spent as your home will be part of the main residence exemption. So they don't care when the value went up or down, they just apportion the whole increase and you pay accordingly. If, however, you moved in from day one, then the whole bit is capital gains tax free. If you move out, the first 6 years capital growth, they will give you that as tax free. So it's called the 6-year absence rule. And a lot of people either are away for more than the 6 years. So what happens then is, if you'd moved in straight away, you would get the market value at the 6-year mark to put a line in the sand. So the capital gains up to that point will be exempt. The growth from that point on will be taxable. So it can be a bit confusing, but the first question is, when did you move in?
I guess it's important to document it all, isn't it, Ken?
Yes.
So you've got to document what the sale price was, what the valuation was at the 6-year mark. And Hamish asked a little bit of a extra twist on it. What if you moved out for more than 6 years and moved back in again? Does the clock start ticking again, Ken?
Yeah, if you'd moved in before the 6 years and then moved out again, you virtually keep dragging the 6 years forward. If, however, you moved in after the 6 years, that period between 6 years and when you moved in would be taxable, but that would then change the method of how they calculate it, because now you've got a tenant in there before you moved in. So you've just got to be a bit careful. But that other point that he made, what happens if I don't rent it out? If you don't rent it out, it's vacant for 50 years, it would still be all tax-free. The only thing is you only get one family home to be exempt.
So you can't move into another home and use the exemption for the next one.
Correct.
Okay, so that was a really complicated question. Thank you for making it simple, Ken. Look forward to catching up with you next week and having another Ask the Expert session.
That other part of Hamish's question about what happens if you're overseas and sell it is very interesting, because the federal government is attempting to change the legislation that if you're overseas and sell an asset in Australia, you lose the 50% discount if you'd had that asset more than 12 months, but they've extended it to the family home, and they're saying if you sell the family home while overseas, you lose the whole exemption, even if you do it within the 6 years. So it's a very, very sharp sword that'll get you. So you've got to be very careful and get specific advice particularly if you're overseas.
That's fascinating, Ken, because there's quite large amounts of money involved when you do that. So thank you very much for making that complex topic a little bit more simple. Look forward to catching up with you with another session next week, Ken.
Thank you very much, Michael.